Hello, everyone. Thank you for joining. We're going to give a couple minutes for folks to continue to join the webinar, and we'll get started in about 30 seconds. Still seeing a few people pop on, so we'll give them a few more seconds and then we'll get started. All right, I think folks are going to continue to join, but we'll go ahead and hop into it. Good morning or good afternoon, depending on where you're joining us from. Thank you for joining the winter edition of our Harvesting Value webinar series. Our goal with this series of content is to provide you with information and resources to help you make important decisions for your operation. My name is Jacob DeBoer. I'm part of the marketing team here at American Ag Credit, based out of the great Central Valley of California, where it is high almond bloom season. It's really a beautiful and cool, special thing to witness. Hope you guys can join us in this area if you get a chance. Before we dive into our presentation, I'd like to remind you of a few housekeeping items. You're welcome to submit questions to our speakers at any time during the presentation using the Q&A feature that you see in the Teams bar here. We will do our best to address as many questions as possible and follow up with all of those who we will not get a chance to get to if that is the case. Additionally, this presentation will be recorded and we will share a link to the webinar with all attendees afterwards. We have not yet had the pleasure of working together. American Ag Credit is part of the Farm Credit System. We are an ag leader that supports America's farmers and ranchers with reliable credit. Our sole mission is to provide access to capital for farmers and ranchers so America can have safe and reliable access to nutritious and sufficient food supply. It's a really critical mission, obviously. Our teams focus exclusively on agriculture. Many of our employees have direct ties to production ag, do a little farming on the side myself. And from small and large operations, we understand that the industry dynamics and how to structure loan solutions to help our customers achieve their goals, protect their legacies, and grow the industry's next generation. Our presenters today are Matt Clark and Anna Young. Matt Clark is Terrain's Senior Rural Economic Analyst. In his work with Terrain, Matt focuses on the impacts of interest rates, land values, and many other macroeconomic trends in agriculture. Anna Young is a senior loan officer with Rural First and serves the central and western Kansas marketplaces. Prior to Rural First, Anna worked with American Ag Credit, definitely a friend of the Farm Credit System, and worked in various roles in underwriting, lending, business development, and Anna still resides near Cheney, Kansas. Matt is going to walk us through an update and outlook on interest rates and kind of the general macroeconomic picture of ag for about 20 minutes, and then we'll have a 10-minute Q&A, followed by the content which Anna will present, which will give an overview of trends in rural living and some of the really unique solutions which Rural First offers, which are nicely aligned with those trends. Anna will also present for about 20 minutes, followed by a Q&A. Thank you for joining us, Matt and Anna, and with that, I'll turn it over to you, Matt.
All right. Thank you, Jacob, and welcome everybody. I'm in the south central Kansas area, so it's a balmy, probably 60 degrees and feels about like it's 90. So hope everybody here too is enjoying some time outside with the family. I titled this presentation Finding the Beat in the Noise, which I realize sounds a little bit odd, but I think as we kind of walk through this, I'm hoping to present to you key things to think about or to have in your back of mind and a foundation to view our current economy and the interest rates so that the headlines and the news stories that seem to be coming at us fast maybe won't have the same emotional impact, but will have kind of that knowledge base impact. But before I get into that, my favorite / least favorite thing to do is to collect my report card. So for those of you who faithfully follow American Ag Credit's work, last November we met and I told you the following things and I graded myself, and I'll keep the receipts for you for what I say here. So next time you join us, you can grade it. If you disagree with the grades, you can jump in on the chat and let me hear it. Last time in November, though, I told you the 2024 economic performance would be good. and 2025 would start out okay, but be full of headlines, which I think went well. Give an A on that. We saw certainly 2024 GDP was very strong. It was a very good year. We also saw inflation remain sticky, which we're going to spend quite a bit of time today talking about. And we also saw the labor market, for the most part, has stayed pretty healthy, or certainly didn't fall out of the bed, though some economists were certainly predicting that. So A on those two things. Where I gave myself a B was on the interest rate picture. So back in November, I made the case that it was probably true that the Fed would cut a little bit further, which they did a little bit, but I didn't see a lot of cuts in 2025. We're going to talk about some reasons why that could be a B, B for me going forward. And then lastly, I mentioned that long-term rates were probably going to stay elevated. There might be some repricing opportunity, but probably very little. So again, we're going to talk about some of those longer term pieces, and Anna's going to kind of bring to you some of the more residential side of that. But there will be some oddities, I think, moving forward in that long-term piece. So let's start with the title here. I said finding the beat in the noise, and if we're honest, the noise is loud, right? And look, we don't need a slide to tell you that, but I thought I would share one anyways because I got a degree in economics and we have to make slides. So here's the slide to show that. These are just uncertainty index that the Federal Reserve tracks. There's nothing out there you wouldn't expect, whether it's U.S. economic uncertainty in blue or global policy in green. Certainly the headlines are full. And if it feels that way, it's not altogether untrue. But often, living here in the U.S., we have somewhat of a U.S.-centric mindset. However, if you think about that green line, that global uncertainty, global economic policy uncertainty, keep in mind over 70 countries held elections in 2024. So that sharp spike up there in green and in blue isn't just the U.S. situation. It's really most of the world. Over half of the global population went to the polls in 2024. And 2025 has started out in the same measure. We've had a number of countries already hold elections. Probably saw some headlines from Germany recently. We still have Canada, we have Argentina, Australia, Norway, Poland. A whole bunch of other countries will again hold elections in 2025. So if you just step back and think about that, the noise is loud because all of that is contributing to headlines, it's contributing to messaging. And often it makes us have a perception that things are better or worse than they really are. But draw your eyes to that yellow line there. That's a stock market volatility index, which again is really right at 100, meaning, yes, we've seen the stock market move quite a bit, certainly to start 2025, but even compared to historical movements, it hasn't been overly volatile. And so I think this is a good way to think that, yes, we will see headlines. Yes, we will see uncertainty. Yes, there is changes across the world. But make sure to ground ourselves in things that we know to be true and things that are data-driven to help make our decisions. And maybe a different way of saying that is I would caution everybody, and I am being careful myself to be clear that there are headlines, but let's be careful on calling our shot. And here's two charts that I spent a long time looking at over the last couple years that I think help illustrate my point. On the left, you're looking at port activity. So this is the number of what would be like a 20-foot equivalent unit going in and out of the major ports in the US. It's a change from the previous year. And on the right is the ratio of private job hires to total unemployed individuals. If you remember coming out of COVID, both of these numbers just took off. We saw port activity left and right. We were buying everything we possibly could. Hirings were rapidly fast. And for a brief period in 2022, we had as many hirings as we had unemployed individuals. However, towards the back part of 2022 and into 23, we saw both of these measures really, really decline rapidly. And if you remember back to 2023, most economists, not most, but many economists were calling that, hey, we're in a recession or there's going to be a recession, and there was tons of problems. Everywhere we looked, there was some sort of problem. In both cases, neither turned out to be true, not to say that everything is okay, but it is to say that be careful on calling your shot when there's just a lot of headlines and a lot of noise. So from here forward, I'm going to try to present to you some metrics that I'm following that I am using to try to ground myself in the data side of it, to get out of the headlines and make sure that I'm having a somewhat grounded view from an economic standpoint. So the first one I would say is, if we just look at the economic conditions, just the broad balcony level data for the US, it's pretty okay. It's not outstanding, but it's decent. So here's two that I look at quite a bit. The first is the blue line, which is just your weekly economic indicators. This comes out from the Federal Reserve Bank of New York. It takes all of the data that comes in the week. So think about payroll data, think about consumer spending data, think about all the bank data on deposits that are going in overnight. And they're just asking, how is economic performance? Again, for most of 2023 and into 24, that blue line was ticking up. Today, it's roughly flat, as it has been over the last, about 2 months, but it is right in line with kind of that average from 2012 to 2019, which was a very elongated period of modest, not great, but modest growth. That's probably about where we are now to start 2025, an expectation of modest, not great growth, roughly maybe a 2% GDP if you were going to translate that into a number, maybe a little bit less than that, which again is similar to what we saw from 2012 all the way through 19. Two, business conditions, which is that green line, is an index that the Philadelphia Fed takes, which is it's a measure of how well businesses are able to perform in this current environment. Again, that number deviates quite a bit around that zero line. We've been on a slight uptick recently, but it's not as though that number is falling out of the bed like you would expect during a recession. You can see the previous two recessions in gray where that green line really, really declined, or excuse me, the green line declined. It's again not in that situation. So from a real balcony level, the economic data is pretty good. What is lagging is the sentiment, or the so-called vibes, is what you hear a lot of. And some ways to think about that now, when you ask businesses how they're doing, the blue line, or when you ask consumers their view of the economy, the purple line, or when you ask commercial banks, are you tightening your credit standards due to economic expectations? Most are saying we expect a poor economy. We expect a worse business sentiment. That's the blue line, the purple line. And the vast majority of commercial bankers are saying, hey, we're tightening credit standards because of our expectations of the economy. Again, those are numbers that we should definitely consider. They don't always historically correlate with great economic times. You can see here those numbers were largely negative from 23 all the way through today. But we've had pretty good growth over the last few years. So that vibe has not matched maybe some of the harder economic data. The big reason for that is because consumers are still out spending. Consumers are still out spending. There's a lot of different ways to look at that. Here, I'm just simply looking at the change in consumer spending, that green line, compared to 2019, January 2019. So pre-COVID, how's it doing? Obviously, it fell off during COVID, makes sense. But then you really see that rapid run in consumer spending at a higher trajectory than we thought we would have pre-COVID. Likewise, if you look at that weekly earnings, so how much are people making each week? Again, in blue there's that kind of weird COVID bump that we got from some government payments and then some kind of making up in terms of hiring. But again, that has grown at a pretty decent pace. In fact, it has here recently even grown faster than total consumer debt in yellow, which would include credit cards, which again, you're reading a lot about in the news. But just stepping back and looking at the data, truthfully, consumers are spending money. Wages are still mostly going up. Weekly earning is still going up. Consumer credit has gone up. It hasn't gotten yet to a place in which we would think, or a ratio in which we would think severe economic issues. Are there struggles out there? Definitely, especially if you start to look towards some of the lower wage earners who have not been able to keep up with that blue line. There's certainly struggles there. There's certainly increases in credit card delinquencies among that subprime group. You certainly see that subprime group struggle a little bit more on auto loans. But if you step back and look at the total picture, so far consumers have been able to spend. They've been able to stay ahead of the bills for the most part. And the economy, as a result, has really had a pretty good run. We enter 2025, for some reason that's cutting off on my screen, but we enter that 2025 in a decently healthy spot for the consumer. So why the divergence? Why do you have the majority of consumers and businesses saying things are bad, but yet we're still spending quite a bit of money? Chiefly because people have been largely employed. People have been largely employed. Here you're looking at a couple different lines. That blue line is the official unemployment rate, which is roughly 4, a little bit below that right now. That kind of gray band around that blue line is the range of unemployment that the Bureau of Labor Statistics calculates. And that green line is my estimate. I only look when I think about unemployment rates, I only look at the working age population relative to how many jobs, private jobs are available. So I try to factor out the government piece. I try to factor out some shifts in population dynamics. I only think about how many people can work, working age population, and how many private jobs are available. And again, my estimate would also indicate that we're maybe a little bit above 4% unemployment. So maybe a 4.1, 4.2% unemployment. Very historically low. If you just kind of draw a line from that end of where we started the year across, we'd be in the lower portion of unemployment historically. So as people have been largely employed and as jobs have been mostly plentiful, despite factors and headlines of layoffs, still been a good spot. People have largely been able to spend money, kind of keep the economy rolling. The burr in the saddle, if you will, or the reason why I think there's still a lot of angst is probably the inflation numbers. Now, we got a bit of an odd inflation report in January from the CPI that really, I think, kind of lit off a lot of this discussion that inflation was rearing back up. It lit off a lot of headlines that consumers were going to spend a lot less because of inflation. And if you think about it, it sort of makes sense. So this group of bars on your left is looking at the CPI, which came out here recently. And I took out all the seasonal adjustments. So this is non-seasonally adjusted. That's what that NSA means. And I looked at inflation from a year ago, 6 months ago, 3 months ago, 1 month ago. And if you draw your eyes to that red bar, that January 2025 number, each of those numbers were going up. That's also true if you think about core CPI, which takes out food and energy, maybe at a less pronounced rate. That core number is seasonally adjusted, so they went through the numbers. Again, maybe less pronounced, but again, you see that trend of maybe inflation is not beat yet. You heard Jay Powell talk about it quite a bit in his congressional testimony last week, that 1 month doesn't make a trend. However, they are not in a hurry to lower rates because they want to make sure that this inflation number comes down. It's true too when you ask consumers, most of them are not expecting inflation to come down. If you look at the right, you've got the University of Michigan and the New York Fed survey of consumers. Both groups are expecting inflation over the next year to either increase or to stay roughly the same, no decline. Because of that, you're going to see probably a more patient Federal Reserve despite the headlines. Now, in red there, you see, watch the Friday PCE report. This Friday, the Bureau of Economic Analysis will release the PCE inflation report. That report will move the market when it comes to interest rates. I'll say that again. That report will move the market. If core PCE, the Fed's preferred gauge, comes in at about 2.8, which would be flat from the previous months, you're going to see expectations of a Fed rate cut really, really decline, meaning less cuts. If it comes in at a 2.6 or lower, you'll probably see the market expect more Federal Reserve cuts. 2.7 is probably no change. Today, the market is expecting some cuts in 2025, but a lot less. But bear in mind, I would call the market at the moment conflicted. So if you go back here to a previous webinar I did in September, in the blue line, the market was expecting that the Fed was going to cut faster than they were today. and that by the end of 2025, we'd be down to 3%. You see that in the blue line. That little dotted yellow line is where we were in November. Today, or as of yesterday, we're in that red line where the market is expecting the Fed to cut roughly in June and then once more in 2025. Again, that's only 50 basis points less than where we are today. Well above that kind of historical 1990 to 2019 average. So if you're pricing loans, there could be some cuts, but again, be cautious, be wise. We'll come back to this at the end on expecting a ton of cuts. Now, if that inflation report starts to come in really low, like I mentioned, or if we start to see more mass layoffs that are really starting to affect those unemployment numbers, perhaps that could drive the Fed to cut a little bit more, but we don't expect that at the moment. Finally, I would say really make sure to listen to that nerdy talk. I put it nerdy talk. I love it. It's my thing. I listen to every Fed speech that I can, every Fed meeting, because of some of these little fun things like the Fed balance sheet, which I find really interesting. For a long time, it didn't matter, but today it does. And here's why. Since June of 2022, the Federal Reserve balance sheet is down about $2.15 trillion. Trillion. I don't know what a trillion is. It's a big number. Their Treasury holdings is down about $1.5 trillion. As the Fed has cut their balance sheet, that's less buyers in that Treasury market and that mortgage-backed security market. You've seen maybe the declines in the Fed funds rate not matter as much to housing price, not matter to loans for like a 30-year home loan or some of those type metrics. You've seen those still rise or still remain elevated. Again, if the Fed decides to continue to cut, you could see some pressure there. If they stop cutting, which I don't know if they'll do that or not, maybe you could see some stabilization. But that nerdy talk will really matter. Today, here's where we are, though. This is what we got, and this is what we're working with. If you look at the prime rate, that purple one, or if you look at the variable and fixed rate these are Kansas Commercial Farmland Bank rates. This is coming from the Kansas City Fed. You'll notice that we've really kind of plateaued a little bit on that blue and yellow line. Whether it's a variable or whether it's a fixed, we haven't seen a whole lot of cuts there. Some of that's due to the Treasury market, which I just mentioned, the Fed reducing their balance sheet is having a big impact. 10-year Treasury has fallen a lot recently, this week specifically, but still it is quite a bit elevated to where we've been previously. And you'll notice that blue and yellow line are very elevated to previously. So you got to go back to kind of that 2007, 2006 period to get back where we were. Should the Fed cut a little bit more, maybe you would see some additional savings there, but it may not necessarily be tit for tat, meaning if they cut 50 basis points, you might not see a full 50 basis point cut right off the bat. It may be a little bit slower. The important part here is what I've highlighted, and that's having a banking relationship. In times like this where that margin is tight there, the difference is small, we're in a cutting environment, there's lots of moving parts, having that relationship with your banker to bounce off different ideas of, hey, what do you see? What options do I have? Can I do a fix to convert? Can I float for a little while? Can I do a different loan structure? That's really where it pays off. So, when I think about the kind of big picture, so what, I would say focus on the numbers, not the headlines. I know that's hard. I'm in that same boat. It's difficult. Make sure to have that relationship with your banker so that you're stress testing your interest rate exposure. So you're thinking about what cuts would do to make you profitable or not. What would happen if the Fed remained higher for longer? Those are sort of the things to think through with your banker. Talk through those discussions, whether that's American Ag Credit or whether that's Anna here. Make sure to be talking through those discussions with them. I'm going to stop here. I could talk all day about this, but it's probably best if I don't. So let's stop for a little bit. I'll take some questions. Jacob, what do we got? And I'll stay on later. So if we need to stay after Anna's gone, I'll answer some more.
Matt, we could listen to your discussion on this all day long, so that's a good thing. As a reminder, if you have any questions for Matt, you have an economist live and on the line. Put them in the Q&A, and we'll go through those live. Matt, I hope that when the Federal Reserve starts using the term economic vibes as an official measurement, that they give you credit, because I think you deserve that credit for that.
Jay Powell said the word vibes in one of the congressional testimony, and I started laughing. So it was great. So we're good.
All credit to you. I'm not seeing any questions come in the chat yet, which is interesting because this is something we get questions on every day here in the branch. So I know they're there. Feel free to share them. But Matt, maybe if you're putting yourself in the seat of a borrower who is looking at interest rates, maybe some of the rates on their current loan products, what are some of the questions that a borrower might start to ask their lender in order to move that conversation forward as they consider pricing and what the market might do?
Yeah, and I mean, as someone who wants to try to buy land too, I'm having these own personal discussions. I know you were in that same seat, Jacob. So I'll just tell you what I'm doing, and I think that will probably answer most of that question. You know, when I sit down, I start with a real broad basis of what are my options? What do I have? You know, for a very long time, just that fixed 15-year note or fixed 30-year note or whatever it was just the easiest thing. You could kind of look up the rate, you could get an idea, you could plug in that payment, you could go with it. Today, I'm thinking a lot more carefully about, well, okay, well, what options does my bank have? What could my lender do? Could I float for a little while? How much would I actually gain, or how much would I lose? What would I be exposed to if I floated for 1, 2, 3 years before I tried to get maybe a fixed note? Maybe there's some sort of other product that's got a structure to it that I'm not even aware of. Maybe there's some sort of fixed for a short period of time, then we go variable again. Are there some ceilings or floors or collars, or, you know, there's all sorts of fancy words. What could we possibly do? And it will make a difference because, you know, you think about just how much land has gone up or how much homes are gone up. Those little micro savings, whether it's on the rate itself or the structure of the loan, adds up to thousands and thousands per year. And so for me personally, I've really spent time putting out a spreadsheet, working with the lender or just myself in the basement, actually stress testing some of these things. And what happens if the Fed cuts twice? What happens if they cut 3 times? What if they go up? How much difference would that be? And for a long time, I was guilty of never doing that, just to be blunt. And I mean, economist, I've been in banking for years. I just kind of figured the 15 fixed and ran with it. Now it makes a difference, I think, definitely.
Well, that is solid advice. And if you have a current American Ag Credit relationship manager, I know that they will more than make the time to have those conversations. And if you don't yet have that connection, you could find a way to get a hold of us. agloan.com is a great place to start.
Are they going to let me out this easy?
I don't know. We're not seeing any come through. I know that you are very good with extended awkward pauses. I have less of a tolerance for that. I think we've opened the door for questions. I'm not seeing any come through. So I think with that, I might say thank you on behalf of all of our attendees today. And we're going to bring on Anna Young, who's going to give us an overview of trends in rural living and some of the convenient products that Rural First offers that play right into that. So Anna, welcome, and we'll bring you on.
Okay, thank you. Good afternoon. You know, when they said the layout of the meeting, I was like, dang it, I have to follow up, Matt. You know, he's always a tough act to follow. So, but very glad to be here with everybody this afternoon. So my name's Anna Young. I'm a senior loan officer for Rural First. Rural First is a strategic partner with American Ag Credit, and I specialize in the consumer realm. So rural consumers. So you know, your ag lenders, either if you have one or you don't have one, if you need one, the ag lenders at American Ag can help you with all the ag needs. And then we specialize in more the residential side. So, and we'll jump into that. We'll jump into that here. So a little bit more about who Rural First is. So Rural First, like I said, is a strategic partner. And Jacob, I'll just have you go to my next slide. Thank you. So strategic partner with American Ag Credit. Rural First serves many different farm credit associations, one of them being American Ag. There's a map that outlines this better on my next slide to just get you a better overall view. So everything in green here is a farm credit association that does partner with Rural First. So Rural First is a division of Farm Credit Mid-America based out of Kentucky. But like I said, we're all in the farm credit system, and there's a lot of strategic partnerships to help best serve our customers and the overall, and most importantly, our farm credit mission the best. And so that is definitely a partnership here. So 19 different states and 15 different associations use Rural First. This is the only real statistic that I have in my presentation. Everything else will be my own personal opinion, but and I think everyone on this call is going to be more than 5 years old. So you're going to remember what 2020 means or what happened in 2020. But according to the USDA, from 2020 to 2021, more people moved to rural areas than left them. And so what does that mean in terms of consumer needs, consumer preferences? And that's what we're going to talk about here first, is just overall, hey, what are some rural trends that I'm seeing as a loan officer in the marketplace? And then we're also going to talk about the products that Rural First, the financial products and solutions Rural First provides to customers to help, like I said, serve the overall farm credit mission. On my next slide, I just have some highlights of, okay, what are those trends that we're seeing? So I know this is a busy slide, but truly COVID changed that time frame. 2020, 2021, COVID really changed a lot of pieces in the marketplace. And probably the biggest one is that flexible work became more prominent in the marketplace. So, I'm in South Central Kansas as well. And I can think of, one of my best friends. He lived in Wichita. He was a large fertilizer provider. He ended up moving back home to where he grew up on a farm during that time frame because he had flexible work and the ability to do that. And I always think of him because I remember many conversations where he's like, I just don't know how I'm ever going to be able to do that. I don't know how I'm ever going to be able to move back to my hometown. It's a very rural community. And COVID really did open the doors for him and for many other people. So, hey, I don't have to live in Dallas or Wichita or Kansas City. If I can keep my job and I can live where I want to live. And we've definitely seen that in terms of demand, and also translates into what kind of products people need to purchase the properties they want to purchase. So the next bullet point, there is technology. So when you're thinking about technology, today we live in a very digital world where it's like, hey, I can be in New York and I can be looking at different properties that are available in South Central Kansas, right? Or I can bid online. It's very common in the Midwest, Kansas specifically, a lot of properties that are sold at public auctions. Even home properties, it's very common here. I know that's not the same in every state, especially I know California, that's not a common thing. Colorado's kind of in the middle, but here it's very popular. So it's like, hey, I can be in Texas and I can be online bidding at 8:00 at night trying to buy this home and or acreage or whatever you want to buy. And I've been a loan officer with Farm Credit for almost 12 years, and I remember where that was not the case. You had to, if you wanted to buy the property, you had to be at the auction, or you had to, talk to people on the phone. Just a totally different process. So the access for buyers has also totally changed. And that was definitely, that aspect grew tremendously after 2020 into 2021 and beyond. Those two pieces, those first two bullet points just really created that demand. So there's just more of a demand for rural properties. People wanted to leave urban areas. And so since then, you have seen a higher demand for all types of rural properties. When I say rural properties here, though, I'm specifically speaking about residential rural properties or lifestyle properties. So, I want to have 30 acres. It's hunting ground. I'm never going to have any farm production. So like I said, nothing that I'm referencing here would be agriculture specific properties. These are all homes on acreage, rural home properties, lots for future home construction, or just strictly recreational rural lifestyle properties. Couple other ones that I just wanted to bring up, typically along the lines of trends. Anytime you have economic uncertainty, that will lead to people move their money, right? So and maybe Matt's talked about this before in macro updates, but in terms of, okay, I have money in bonds, stocks, and I want to put it into hard, tangible assets. And you will see that during times of economic uncertainty, which you had, I would say, 2020, 2021, people were uncertain about what was happening in the world. Definitely not going to be the biggest driver, but it is something that you see. And then the last couple here really fall into that rural lifestyle property where, people, they want to have a rural lifestyle property for them to enjoy with their families today, but they also want them to, pass it on to their family or children or whoever that may be for future generations to enjoy as well. So not necessarily a farm that they're passing down, but more of a rural lifestyle property specifically. Okay, so talked about some of those trends, and all those trends really are on, when I was thinking about what am I going to talk about at this webinar, all those trends are truly things that I have talked to customers about. Those are real life situations of things that I see over and over again. Like Matt said earlier, a trend is not just one bullet point. This is, or one occurrence, they have to happen many times, and those truly come up with customers a lot. The next piece that I would say though, as those trends have played out, the next thing that I see a lot when working with customers is a lot of these folks have never purchased property before, or maybe a rural property. So many of them have purchased a home in a town, right, or a city, but they've never purchased bare ground or a rural residence type property. And so I get those questions a lot too. It's like, hey, I don't even know where to start. Like, what am I supposed to do here? Or I've never bought anything at auction. This is super intimidating. So I always tell people, step one is to get pre-approved. We work with people all the time. We have a great pre-approval, pre-qual process for folks, but it truly just makes things so much better when you're like, all right, let's get started. Let's see where you're at. There are some different qualifications for, if you're buying bare land or a rural home that are going to be different than if you're buying a house in Wichita, right? Or wherever you may live in an urban setting. The other thing would just be a timeline. Sometimes that pre-approval, it's good for a certain amount of time, but I work with people to say, okay, if you're wanting to accomplish something in this timeline, let's really set you up for success to get that done. And the last one is work with someone who knows what the heck they're doing. So if you're working with a real estate agent, definitely you want to work with someone who's experienced. Different counties have different rules, and I would say that's probably the biggest one. Sometimes like Butler County, we're in Sedgwick County here in Wichita, but Butler's the next one over, and they have different zoning laws. So I always tell people, make sure you're working with a professional who knows the area and knows what they're doing and can help you. Because a lot of people, like I said, it is their first time purchasing something, and there's nothing wrong with that. And there are people who can help you get it done smoothly. So this goes back to, sometimes when we're talking about trends, rural properties, what people are looking for. This is another question that I get commonly. And I like to talk to people about, hey, when you're talking about a rural lifestyle property, or you want to live in the country or in a rural setting as your primary residence, or maybe it's not your primary residence, but you want to have the property, sometimes it's easiest just to break it up into little steps. And so besides the pre-approval, we're past that piece. They've purchased the property. And one of the pieces of being part of Farm Credit, Rural First, we are really here as a solution for you the whole way through the process. So if you're purchasing land to build in the future, we can help you with the land purchase, build the house. A lot of people want to add additional structures, shops, barns, whatever you want to call it. And people call it different things in different areas. Adjoining property. These are all things that come up very commonly with people who want to have a rural lifestyle or purchase a rural property. And we really can help people understand, hey, this is how we can break this down to ultimately get where you want to get in the process by, as we have the different product solutions to help people ultimately live out their rural lifestyle dream. So talked about trends. The next part, I'm just going to go through, okay, what are the product offerings that Rural First offer for American Ag Credit customers, or, even if you're not an American Ag Credit customer, that's fine. We provide solutions for whichever, it doesn't matter which group you're in. You don't have to be an American Ag customer. We're happy to help you. Our products, like I said, we're going to specialize. These are the 4 core products. Home construction, existing home loans for rural properties, or bare land. The lot loans is bare land. When it says land loans, again, not agriculture, these would be more truly like rural lifestyle properties. So they're not going to qualify for an ag loan. These are very much meant to be a strategic and complementary product of American Ag, and we serve different mission or different pieces of the mission ultimately. So we'll jump into the next slide where we talk through the product a little more in depth. So the first one that I wanted to touch on is just going to be the lot loan, because this is where so many people start. If you go back to, okay, what's the best way to break this down into steps to ultimately get to your goal? This would be the first place a lot of people start. So if people are looking at different properties that are bare ground, there can be like shops or different structures, but there's no home ultimately, typically on the property. So we have great financing solutions for these. I'm not going to read off the whole slide. What I want people to really take away from this is, if you're looking for bare land specifically to build a house, we have a great lot loan product. And we don't have an acreage requirement. So sometimes typically 5 acres, but it can be less or more, just depends on the situation. So I've worked with people who, hey, I'm building a house in the middle of 80 acres. I'm building it on 5 acres. So we see all different kind of scenarios there. But ultimately, if you have that need and this is where you're looking to start, we have great solutions to help you get the first step, which is a lot of times, like I said, purchase the lot. Next product is going to be, there's an existing house on the acreage, right? So also very common. So this is going to be, an example I always use is there's 20 acres with an existing house, or barn dominion. We are very friendly towards barn dominions, and they're definitely popular in my area. I know they're popular quite other places, and barn-do can mean a lot of things to a lot of people, but we do finance those in addition to homes, cabins, log cabins. We're very flexible on type of homes, given that we are strictly a rural lender for homes. So, a lot of times these are the things we are coming across. I know in different parts of the footprint as well, Colorado, Nevada. I have teammates that cover the full American Ag Credit territory, and they run into different things. I know I was talking to the Nevada lender. He had one recently that was off grid. So, we're not a lender where we're here to make a home loan and sell it. We're going to hold the paper, and really we're here to help serve rural communities. And a lot of things we finance don't fit well in a traditional secondary market type loan. So again, no acreage limits on there. We don't have private mortgage insurance either, because we don't sell our loans. So they are on Farm Credit paper, and we hold them the whole time. Construction. So very, very heavy construction. So overall, Rural First as a whole, I would say about 44% of all the loans Rural First puts on is going to be new construction. I'm pretty close to that. In Kansas, it's about 40%. So we have a great construction product. Again, when you think back to, we're serving rural communities, so a lot of times it is, hey, people are we're financing the lot loan for people. And then the next step is we're going to finance the construction, whether it's a home, stick-built home, barn dominion, modular. I finance a ton of modular homes in Kansas, not manufactured, not mobile homes, but modular homes. And a lot of that has to do with the area that we serve. So every area is going to be a little different in what they see in terms of types of homes, but we do have good solutions for all of those. Like the modular piece, I know I mentioned that. Those are very popular, especially as you get into Western Kansas, just because access to general contractors is different than in South Central Kansas or Central Kansas. So we see a lot of different things, but our products are really meant to help anyone in those type of situations. If you're building in a very rural area where you may have challenges, we also work with self-contractors as long as they're qualified. So there's a caveat there, but again, we're here to serve the rural community, which sometimes those are just different challenges than what you would see in a traditional secondary market type situation. This product it's called Rural Ranch. I wanted to highlight it because it fits really well. It really ties into the trends piece of this presentation in terms of, we have seen various trends play out since COVID, primarily, is the big driver there. And part of what those trends have created is really a demand for different financing solutions. So the Rural Ranch product is what it's called. It really came out of a demand piece following COVID. They did a pilot on this program in Texas, and then ultimately they rolled it out to all Rural First Partner Associations in 2024. I don't remember exactly when in 2024, but I want to say like mid-year. And it's a great solution for people who, I'll give you an example. Like I had one where the individual, he lived in Wichita. He wanted to buy a home just outside of about 25 miles north of Wichita. They were going to keep livestock on the property, use it as a rural lifestyle property, right? And it was 20 acres and a house. And we were able to finance that essentially like it's an extension of his primary home instead of a secondary home. So the terms of the product are much more friendly than what would be typical for a second home type financing. So I've had several of these. I've had I can think of another one where the individual lived out of state, but he was from Kansas originally, or they were from Kansas originally, and they were, they decided, hey, I'm going to build a barn dough. We come back to Kansas about 4 months a year, and we work remote, so we have the flexibility to do that. They lived in Texas, so just a really great product for people who they have that flexibility in terms of where they work, and they want to have another home that they use a good amount of time. So different than a second home. So just a really good product also for lifestyle buyers. We work with a lot of folks in Kansas, at least, who, they're buying lifestyle properties, whether there be hunting, et cetera. That's a common one, not ag production. So on those, we will work. This solution a lot of times works well for those folks as well. So, and it can be an existing home. I've had them be existing homes, like the example I rattled off, or new construction. We can help them with either need if they meet the product. Not everyone qualifies for this product. There's some criteria, but it was truly a product, like I said, that Rural First added due to, hey, we're seeing these trends in the marketplace in terms of what consumers want. And so we're going to go ahead and shift and adjust our product offerings to accommodate those pieces. These are our mandatory disclaimers we have to give to be within the law. And then the last, you can read that at your own will. We just have to put it on there. And then contact information, if you have contact information or you want to get in contact with a lender, like I said, we have different Rural First loan officers who cover the entire American Ag footprint, and I'm in Kansas. This is the website or the number that you can call to get in contact with us. The one other piece I will add, just Matt mentioned this, and I thought of it during Matt's presentation, would just be on rates. And I would say consistent with what is Matt saying is what we're seeing in the rate market. One other piece, as far as on the residential side of the products that we offer to help people with those conversations in terms of rates, is that we do have a really great rate conversion option. So if you're interested, you want to know more information, like I said, about products or getting pre-approved, just reach out to your local contact and they'll be happy to help you.
Well, awesome. Thanks, Anna. We now have time for Q&A for your portion of the webinar. Reminder again, put those in the Q&A. I do see a couple that came through, so we will go through those. And the first one I see came in, and I imagine this is a nuanced response, so I'll set you up for that. But are there typically interest rate differences between ag and lifestyle property loans?
Correct. Yeah, there will be. And it just kind of depends on what they're after, right? So if you're financing a lot loan is going to have a different rate versus if it's a construction loan for your primary home or an existing home on the property. So part of it's going to depend on the product, part of it's going to depend on the term. But they are going to be, it's a different type of pricing, correct?
Got it. Another question I see came in, and I think you might have touched on this, but on modular homes, is Rural First able to finance those?
Yes. I think I did 8 or 9 new construction loans on modulars last year. So as long as it's a true modular, it's not a mobile home. That's the piece there. Sometimes there's a lot of marketplace confusion about, well, what is a mobile home versus a modular home? So I always tell people if it's ever had a tag, a HUD tag, it is technically a titled vehicle. It is not a modular. So, but yes, we have a great product. I mean, it's just a construction loan. We treat it like a traditional conforming house. So there's not any weird hoops to jump through. And at least in Kansas, you know, we have some really great relationships with the folks who sell modulars at different locations in Kansas. But yes, we can definitely help you.
Awesome. Those are the questions that I see have come through, you know, specifically around Rural First products. I'm probably going to be spending my evening taking a YouTube University deep dive into barn dominiums, because I think those are a pretty cool thing, popular out this way in California.
Yes.
So thank you for joining, Anna. I think we're going to do a bit of a bonus round and go back to some questions that have come through more on the interest rate policy side of things. So Matt Clark has volunteered to stay on. So we'll go through those now. Matt,
coming off the bullpen. All right, bullpen time.
Welcome back. Welcome back. You had a little break, but you're back. All right, and we're gonna dive right in with this one. So how about some general thoughts around what the market movement might look like if tariffs do go into effect? And I imagine this is a very, again, nuanced depth one, but what do you got?
Yeah. And we're talking, the question was specific to interest rates, what interest rates would look like.
I think it's fair to funnel there because otherwise we might have to schedule another couple hours. So yes.
Yeah. So I think the first thing I would say is, and this will be very unsatisfactory to everybody, but we don't know. And again, you got to be really careful on jumping to quick conclusions on that. So, you know, I think the big question is around inflation. And again, we just don't know because we don't know what products it would impact. So if you think about the last, I would say 2-3 years of things that have been inflationary, they're largely things like rent, recently eggs, gas at one point, you know, things that aren't, they're not imported items. They're things that it wouldn't affect. And so to try to pin down what exactly would happen, it would be a lot of guesswork. And I know that is very unsatisfactory for everyone, but it would at this point be a true guesswork measure. And so you know, when you hear Jay Powell talk too, and again, as unsatisfactory as this is, he's making those same comments of like, hey, when we know something for real, we'll actually start to try to put it in models and take estimates and guesses at it. But at the moment, it would be a complete assumption, and that's really not fair to do. I think it's a little dangerous. I know there's textbook answers we can give, but even those in the last run turned out not to be true. So it's just, sorry for the unsatisfactory answer, but I would highly recommend everyone to be careful with jumping too far one way or the other on those kind of assumptions.
That's fair. I think we appreciate real talk over textbook responses. But I appreciate your ability to give us the tools and indicators to watch, because none of us have crystal balls, but we can all, you know, make the best conclusions we have based on the data that's in front of us. Another question that came in was around kind of some of the data that you offered with consumer spending being, you know, relatively strong and staying strong. How do we rectify that with so many commodities or ag products such as cotton or tomatoes out on the West Coast here. Really
Yeah,
struggling.
some
We're
Central Valley
struggling
questions
to
there. I
kind
love
of-
it.
Yeah, there you go.
Okay, so maybe a comment, and then I'll get to the question. The comment, I would say consumer spending and the second part of 2023 and most of 2024 was really good. The back part of 2024, it slowed down, is just sort of that compounding effect of inflation slowed some spending. And I think now probably it's slower, but still hanging in there. If you remember those charts I showed you, maybe the trajectory isn't quite as fast, but it's still hanging in there. How long can that last is largely going to depend on how well people stay employed, is my big picture. As it relates to commodities, I always want to draw a line between commodities that are very, very close to the consumer versus commodities that are further from the consumer. So if you think about beef, which is very, very close to the consumer, not a lot of transactions between the two of those, they have seen a very, very strong run in prices. A lot of that's due to supply, a lot of it's due to demand in our consumption of beef because of strong spending. Where that breaks down is when you get into commodities where the distance between the farmer and the end product is high, or to say that a different way, the farmer's share of that dollar is consumer dollar is very low. So cotton's a great example. Most, not all of our cotton is processed here, sent over across the seas in bales or rolls, reprocessed into something, whether that's in your area, the Pima, a little higher quality, or whether it's in my area, the Upland, a little lower quality, and then sent back here for consumption on our side. As a result, that share that the farmer has is tiny, and so consumer spending going up or down does make a difference. It's probably not enough to outweigh some of the supply and demand issue things, and that's where you get into how much is Brazil producing, how much is the Black Sea producing, all those sort of questions then weigh in more heavily for those products that are very far removed from the consumer. I love the Central Valley question. If we have more little on that, especially on the processing tomato, I'll tease Matt Wolf, our expert on Central Valley commodities, is I would say a tomato paste expert as well. He'd be great to run into those with you.
I think that is a great response and a good plug for the local expert. So that is appreciated. Well, those are the questions that I am seeing in our queue. So we'll call that what we have time for today. Thank you for joining our edition of the Harvesting Value webinar series. Look out for the invite for the next edition, and thank you for your time today. See you all later.